Last week, the Chancellor announced that the cash ISA allowance was being reduced from £20,000 to £12,000. And just a day later, HMRC published notes around closing loopholes that would circumvent these changes. These proposed changes include not being able to transfer from a stocks and shares ISA to a cash ISA, tests to determine whether an investment is eligible to be held in a stocks and shares ISA, and then finally a charge on any interest paid on cash held in a stocks and shares ISA. And these rules will apply to just investors under 65. This has quite rightly caused a lot of distress and angst among investors. And I could rant about this forever, but in this video I'm going to focus specifically on what your practical options are if changes like these are implemented. The first thing I need to say is not to panic. The proposed changes to the cash ISA are not due to come into effect until April 2027, so you have plenty of time to decide what to do, and you don't need to make any decisions right now. It may even be delayed if there's enough of a pushback or if the legislation takes longer to implement than expected. We may even have a general election before then, with the latest an election could be being 2029. It could also be anchoring, and we saw this a lot in the lead up to the budget, where an idea would be proposed or accidentally leaked that would be fairly controversial, and the idea is that when the budget then came around, it wouldn't feel so bad because people are expecting a lot worse. And this could be the same here. These are just essentially rumours for now, and this could be watered down by the time it comes to implement them. With these proposed changes, there's understandably going to be a lot of questions about what would happen in a specific scenario. And while we haven't got a definitive answer yet, I think we can get a rough idea of looking what the rules were like pre-2014. From 1999, when the ISA was first introduced, until 2014, the cash ISA and the stocks and shares ISA had different allowances. There were limits on transfers where you could transfer from a cash ISA to a stocks and shares ISA, but you couldn't transfer the other way around. To cover off the cash-like investments held in a stocks and shares ISA, HMRC used what they referred to as a 5% rule. That means there needed to be a relative possibility that investment could fall by 5%. So that ruled out money market funds, very short-term bonds, because the likelihood that they wouldn't fluctuate by more than that 5%. It didn't affect dividend payments, so if you had a dividend payment from a company that then sat as cash in your account, that was generally fine. And it also didn't affect cash that was due to be used for investment purposes. For example, if you deposit into a platform and then you might not invest for a couple of days or even a few weeks, that was fine as well. And they generally used up to about 6 months that you could hold cash, with the idea that it would be used for investment purposes. There was interest paid on cash held in the stocks and shares ISA, but this was paid net of tax. And this was paid net of a 20% basic rate. It didn't matter how much you earn. So if you earned nothing, you wouldn't get any tax relief. And if you earned higher rate tax, you wouldn't get 40% tax rate. Everyone got the standard 20% already taken off before that interest was paid. And this is what makes it so complicated to implement. And there's a lot of pressure and onus on the providers here. They have to manage the interest part, as well as determining whether an investment is cash-like and then working out what to do with that. The retail investing world is also so different to what it was pre-2014. Things were arguably a lot simpler back then. We have a lot more options available right now, whether that be ETFs or money market funds or more cash-like equivalent investments. Or it could just be life strategy funds where they mix equity and cash-like equivalents together. But in the worst case scenario that these proposed changes are implemented, what are your actual practical options if you do want to de-risk your portfolio or simply just hold cash tax-free? I don't think this is so much of an issue for new money going in. You've still got your 12k cash ISA allowance. And remember, you also do have a tax-free allowance outside of an ISA. For basic rate taxpayers, you can have £1,000, and for higher rate taxpayers, you can have £500. For example, if interest is paid at 3.5%, that means for a high rate taxpayer, you can have around £14,000. And as a basic rate taxpayer, you can have up to around £28,000. You do also have the option to invest in premium bonds, and you can have a total of £50,000 invested. This is a prize draw, so the rates are variable, but they tend to average about 2 to 3%, but it is totally tax-free. I think the main issue with these proposed changes is de-risking prior to a large purchase, such as a house or early retirement. Remember, these changes only affect people under 65, so it could be the case that you want to retire at 55 or 57, depending on when you could take your private pension. And you may want your ISA to help supplement your income. And that gap between when you first retire and then 65, that could be when you might have an issue. If you wanted to de-risk your portfolio, say for example, you were looking to put a deposit down on a house in the next 2 years, and you didn't want the volatility from the equity markets, with these changes, you wouldn't be able to transfer that into money market funds, hold that as cash, or even use things like short duration government bonds. It's likely bonds anywhere up to 5 years wouldn't be allowed with these changes. This will be a little subjective, But likely the safest thing that you could use inside a stocks and shares ISA would be medium-term government bonds. That's about anywhere from 5 to 12 years. With these types of bonds, you wouldn't really have credit risk because you're lending to the government, but what you would have is duration risk. And generally, the longer the term of a bond, the more fluctuation is possible in the price of that bond. Bonds are fixed income, which means they pay a fixed rate of return. And that means any changes in yield directly affects the price of a bond. So if yields were to increase, the value of your bond could fall and you'd still be getting the same rate of return. So really your options, if you want to have a virtually risk-free holding, is to use premium bonds or hold cash or money markets outside of an ISA. Your main risk here is going to be loss to inflation. If you were taxed on the interest that you gain outside of an ISA, if you're a high rate taxpayer, your savings tax rate is now 42%. If the interest that you gained was 3.5%, this would reduce it to about 2%, which is generally going to be below the inflation rate. You could offset this slightly by using money market funds, which will pay slightly higher rate of return than simply holding cash. The current rates are sitting around 5%. They will fluctuate. But if you took that tax off, that then reduces it to about 3%. But you have to be comfortable with the differences. It can still fluctuate and it's still not the best rate of return. You could, of course, use a combination of these approaches. You could put 12K into a cash ISA. You could put 50K into premium bonds. If you're a higher rate taxpayer, you could put 14K outside of an ISA before you're taxed on any interest. You could have a small part of your portfolio still in the stocks and shares ISA, but held in medium-term government bonds, so you massively reduce your volatility. And then the rest you could hold outside of an ISA, which would still get a small rate of return. The other thing you could look at if you have a mortgage is to overpay it. If you're not wanting to invest into the stock market because it feels quite toppy and you feel like a crash or a correction is coming, and you may just want to park some money and still get a return, you could overpay your mortgage, and paying down any debt is a guaranteed return on your money at whatever interest rate that you're charged. The downside to this in the short term is that you can't get that money back once it's paid. So any debt that you pay off, you're not going to be able to realize that in the short term. There's going to be a lot more rumors and speculation about this in the months to come. But until we've got a definitive set of rules, we can't make any decisions. So really don't panic now. But I just wanted to highlight some potential options that you do have if changes like this are implemented. If you want a more lighthearted video, this is me reacting to finance videos on TikTok. So watch this one next.